Investors all have their eyes on the Fed statement, but more importantly, what Ben Bernanke is going to be saying at the news conference. For what to expect, I want to bring in Dino Kos. He spent much of his career at the New York Fed, ending as the vice president of the markets group and now the managing director at Hamiltonian Associates. Great to have you back, Dino.
Good morning.
Okay, so a lot of people say, look, we're not going to expect any move out of the Fed and perhaps even really not out of their statement. So most importantly, what will you be listening for in his Q&A?
Well, I'm going to be listening for two things, really. In terms of what he says, is I expect him to say that the Fed is as if we're on hold now. They're not going to do much now, but
Yes.
Are they going to be ready to do more if the situation deteriorates? And I think what the questions are going to be getting for it is does that mean that you need a deterioration in the real economy, or is a deterioration in markets enough to trigger some kind of a response? So how does he respond to those questions?
What have they looked at recently? What have they looked at recently?
Well, the last couple of years, when they've started to ramp up asset purchases again, I mean, it has been when inflation has started to fall, and they've been worrying about a drift towards deflation. So any time that you have had that shift down in inflation rates, they have responded to that, and that's also coincided
by putting money in.
By putting money in, by buying assets, by buying treasuries, and the like.
Well,
so
we're not in that situation.
We are definitely not in that situation. But what investors care about is what are they going to do in the future? So what's the reaction function of the Fed? So that's one thing to look for. What does he say there? The other thing is what's in the accompanying statement. And right now there are 6 members of the FOMC meeting participants that think that policy should move off of zero before 2014. So, the Fed has said we will keep rates at zero at least until the end of 2014, but there's a wide variety of opinion. And you have 3 members of the committee that think that rates should move off of zero this year, and 6 total that think that it should happen next year. So now, how does that change at all? Okay, do you have people moving into the hawkish camp, or do some of the hawks move into the dovish camp? So that's the second thing.
But does it matter, though, because Bernanke is clearly the most influential member of the FOMC, and he's clearly the one that's, wields the influence and wields the policy, right?
He is. He absolutely is. And the leadership is united. The 3 main members of the committee, they're united. However, what this tells you is what are the wings of the committee? How is the center of gravity moving? And because right now, if you have a big shift towards the hawkish camp, that's not something that the chairman can ignore. And right now, markets are priced for that end 2014 exit or later. Well, if that changes, if that gets moved forward, you would get a pretty sharp market response, that's for sure.
Well, what do you think he's watching? Do you think he's watching more the jobs market, or do you think he's watching the equity markets?
I think what he's really watching is Congress. Right now, we have this so-called fiscal cliff, and there's a lot of worry in Washington that if Congress doesn't act, you will have this big fiscal tightening next year. And I think what they're worried about is that they not compound that. So there's this view that you need to stay easy until that situation clarifies. The worst situation would be that you have a tightening in financial markets at the same time the fiscal policy is about to tighten because of tax increases. Are you
really saying that the Fed, Chairman Bernanke, is watching Congress, and if, let's say, we approach this fiscal cliff and we don't pass these tax cuts, that he could actually respond to policy like that by putting more stimulus into the economy?
Well, I mean, what I'm saying is that if you get that kind of fiscal cliff, Congress doesn't do anything, you will have a sharp decrease in economic activity, and he wouldn't have to point to Congress necessarily. He would just look at the data and says, look, the economy is slowing, markets are reacting, I need to respond.
And the more transparency that we have seen from the Fed, has that been good for the markets?
I would say this: it hasn't been bad. Markets always want to know what will happen, which means foresight into the future, and that's just not something that people have. Nobody has it. The Fed doesn't have it. And the thing about the Fed is they want to keep their options open. They want to have flexibility and discretion with policy in the future. So they don't want to pre-commit too much.
Right, they don't want to lock themselves or corner themselves there. Okay, Dino, thank you so much. Great to see you, Dino Kos of Hamiltonian Associates.